Hi, my name's Evie Truong, and today I will be presenting the Not the Teal Book May 2023 Consensus Seeking Committee edition. So the presentation that follows will be targeted towards a group of market analysts, which means it will present the technical underpinnings of the policy decision at a level that would be accessible to somebody who has an economics and finance background, but it will also be available for the public for transparency purposes. So this exercise has been constructed on US economic data, and it reflects current US monetary policy objectives of price stability and maximum employment. But as mentioned, the analysis underlying this presentation, as well as the presentation's structure, style, and content, were deliberately developed in such a way as to reflect decisions that would be made by an established consensus-seeking monetary policy committee. In this exercise, we assume that committee members aim to reach consensus both on a baseline economic scenario and on the current appropriate monetary policy settings today. The guiding principle is that the committee will attempt to present a clear and united view of the appropriate future path of interest rates in order to provide clarity to markets, to maximise effectiveness in communication, and thereby support the committee's ability to influence market interest rates beyond the very near term, that is, influencing the term structure further out into the curve. And our decision to communicate expectations using a single baseline scenario should not be interpreted as an indication of greater certainty than if two or more scenarios were presented. Rather, the baseline serves as a mechanism for expressing the consensus view that has been developed by the committee. Individual committee members will have different views on the risks. All committee members acknowledge that there are significant risks to any baseline scenario, and they will place different weights and probabilities on different outcomes. However, the baseline serves as a core expression of the agreement that the committee has made today. So in context, inflation is currently too high. In recent periods, aggregate demand has exceeded aggregate supply, and short-term inflationary pressures have passed through to higher inflation expectations, which in turn have influenced longer-term domestic price and wage-setting behaviour. That means that a sustained period of slow economic growth in the US will be necessary to ensure that we can meet our price stability and employment objectives sustainably in the medium term. Today's decision supports our view that the economy needs to slow further than it has already, and that growth rates need to remain below the rate of potential output growth into the near future. So now I'll move on to the core analysis underlying this view. Starting with the global economy. So global economic conditions continue to soften in line with expectations. Ongoing conflict in the Ukraine continues to weigh on global food and energy supply, but to a lesser extent than it did in 2022, as global economic trade links have adjusted to the initial disruption. This means that while prices for some goods, particularly food and energy, remain elevated, prices for those goods are not continuing to increase. Growth in advanced economies is expected to slow further into 2023, reflecting the coordinated monetary policy tightening that's already occurred in many advanced economies. However, some economies continue to show signs of resilient consumer demand, suggesting that higher interest rates may be necessary to achieve the expected level of slower economic growth over 2023. A key factor in global economic conditions currently is the reopening of the Chinese economy. The earlier than expected reopening appears to be easing global supply chains, particularly in the Asia region, which supports lower inflation in the short term. After a strong start to the year, China's activity levels have disappointed, leading to lower overall activity levels in the Asian region, and Chinese inflation surprised significantly to the downside in May. Last night, the PBOC cut its policy interest rate by 10 basis points, reflecting weaker levels of activity and lower inflation coming out of China. So on net, China's re-entry is expected to provide a modest support to economic activity, mostly through improved supply capacity. That means in the short term, we're likely to see continued negative influence on prices. However, over the medium term, as the Chinese economy does continue to reintegrate, it is expected to support sustained level of economic activity. Reflecting a lot of these factors that have already occurred, oil prices have fallen considerably over the last 12 months, and this has been a key contributor to declining headline inflation through both direct and indirect channels. In our baseline projection, oil prices are assumed to move broadly in line with this forecast, stabilizing near or slightly above current levels as growth continues to slow, in line with forward expectations that support today's price level. And while oil prices are always a significant source of uncertainty in any baseline scenario, we believe that the upside risks to the oil projection are more pronounced at the current point for several reasons. On the demand side, diminished oil reserves are expected to provide a floor for prices, particularly in light of rising geopolitical tensions. So as you can see in the red bars in the chart that we're looking at here, global oil stock levels have fallen over the COVID period. The gold bars indicate that stocks have increased in recent quarters, reducing incentives to rebuild stocks if prices remain high. However, if prices continue to fall due to softer than expected global activity, for example, this would increase incentives to build stocks and provide some upward pressure on prices. On the supply side, strong cooperation by OPEC is expected to result in responsive oil supply, acting as another limit on downside oil price pressures. As the lowest cost supplier, OPEC has the ability to influence the price level more as the price level falls, and the higher cost producers are less competitive in the market. And other global commodity prices are projected to move a little bit differently in our forecasts and are expected to ease in light of weaker demand out of emerging markets, particularly China. Moving now to the outlook for the domestic economy. Domestic demand has proven resilient to tightening monetary policy to date, as evidenced by the latest GDP Now projection for activity in Q2, which suggests 2.2% annualized growth in the second quarter of 2023. This reflects a relatively robust labour market and ongoing strength in consumer demand. While it is the case that recent hikes in interest rates will still take considerably more time to pass through to the domestic economy, it does suggest some upside risks to current market expectations for GDP growth going forward. And at these rates of growth, aggregate demand is expected to continue to exceed aggregate supply, which supports underlying inflationary pressure. On the other side of the coin, bank lending conditions have tightened in March following the failure of Silicon Valley Bank and several other institutions in the US and Europe. As you can see in the yellow dotted line, most indications of bank lending tightness or tight credit conditions suggest that credit conditions remain much tighter than they were going into the start of the year. And this has the potential to weigh on economic growth going into the second and third quarters of 2023. However, our core expectation is that these effects are likely to be short-lived and largely constrained to riskier corporate lending, particularly in the tech sector. Overall, by the end of this year, lending conditions in mortgage markets and for high-quality corporate debt are expected to be broadly consistent to what they were at the end of 2022, and this factor is not expected to materially weigh on growth beyond the middle of this year. Moving now to conditions in the labour market. The unemployment rate remains near record low levels, indicating that although demand is slowing, it has not yet slowed to the extent that aggregate supply exceeds aggregate demand in the labour market. In order for the output gap to close, labour market conditions will need to normalise, and it's very likely that we will see an increase in the unemployment rate. This increase is expected and necessary to see inflation settle near its target over the medium term. While we've yet to see material easing in the unemployment rate, we have begun to see some indication that labour market conditions are already easing in the vacancy rate. So the chart in front of us plots the Beveridge Curve the relationship between job openings and unemployment rate. And we can see that, as is typical at very, very low rates of unemployment, earlier adjustments in the labour market in this cycle have mostly been in falling job openings. However, over time, as economic demand continues to slow due to higher interest rates, we do expect to see a movement along this Beveridge curve where unemployment rate begins to rise. And in line with this, it is critical that elevated wage growth begins to slow. So one of the key supporting factors to the strong domestic activity that we have seen, one of the factors contributing to high inflation in recent months, has been robust demand in wages. While it's very promising to see CPI headline fall in response to high energy prices and some short-term effects, it's not until we start to see the effects of this lower CPI inflation reflected in lower wage growth and more moderate core inflation that we will be comfortable that interest rates are sufficiently contractionary on the economy to ensure that some demand and supply are brought back into balance over the medium term. Which brings us neatly to the outlook for inflation in the economy. So year on year, we have seen significant declines in commodity prices, particularly for oil, and this has had a significant effect on headline inflation to date. However, when we look at parts of the economy that are more sensitive to domestic interest rates and more sensitive to current domestic demand conditions, such as services inflation, we can see that the moderation has been much smaller and that this level of inflation still stays near record highs. Similarly, underlying measures of core inflation suggest that there is some significant persistence in the inflation that we have seen to date. And this brings us to the outlook for monetary policy. Current market pricing, as at the end of April, assumes that the Fed funds rate has effectively peaked and that no further tightening will be required to constrain demand and see inflation return to a sustainable level. Real GDP growth is projected to be temporarily elevated, but then slow quite considerably over the medium term in light of monetary policy tightening, which has already occurred to date. And core inflation is projected to continue to ease over the coming years. However, it's the view of the consensus-seeking Monetary Policy Committee that higher interest rates are necessary to achieve these outcomes. Today, the committee agreed by consensus to hold the Fed funds target rate at 5 to 5.25%. However, the committee agreed that, conditional on current baseline economic projections, further tightening is likely, and a peak interest rate closer to 5.5 to 5.75% may be likely. So this outlook has been communicated already via our media briefings to financial markets and the private market. And I will leave it there, open for questions. So I'll just stop sharing my screen there and I will launch into the second part of the assignment, which is to provide a review of my own analysis and assessment. I think that presentation broadly included all of the points that it needed to cover. Thanks very much to Jared and the excellent slide set that I had to back me up. But there were a couple of things that could have been done differently. In particular, I think that the way that I tied the baseline projection to the monetary policy decision could have been presented a little bit differently in light of the fact that we are working with a consensus model here. It might have been a better idea to start with the consensus decision, to start with the interest rate conditions that we assume in our baseline projection, and then move on to the projections for global growth and core inflation. The reason for this is that when you present a baseline projection, it's really important that it's well understood the endogeneity of the monetary policy decision and that your central projection and your interest rate decision are consistent. Another thing that I would have liked to have done is had a little bit more forward-looking analysis around domestic activity and labour market conditions. So I spent a lot of time on the global economy and global drivers in a more forward-looking sense, looking at the outlook for prices and the outlook for global inflationary pressure. However, I didn't have a very thorough analysis that was linking today's wage inflation to the wage inflation projections and what the drivers of that change would be, other than the interest rates. In other words, I think in the US economy, there are a load of exogenous demand drivers and endogenous demand drivers that I could have spent more time characterizing, and that would have given markets more information with which to interpret the conditional forecasts that we put forward. But overall, that was a really fun exercise. I think that I covered the key points, and I'm looking forward to receiving your questions. Enjoy your presentation in the morning. Bye, everybody.